RRIF savings is not a retirement plan. So how do I protect my retirement from unforeseen threats? What happens to your RRIF when you pass away? I think that's the wrong question. The first step in getting your retirement plan is... Hello and welcome to another episode of Your Retirement Planning Simplified. I am your host, Joe Curry, and I'm riding solo today because unfortunately Lindsay's feeling a little bit under the weather. So you just got me. So for today's episode, what we're going to do is I get a lot of questions about RRIFs, like tons of different types of questions, which is understandable because our whole life we've been saving into RRSPs. And all of a sudden someone, tells us we're going to have to change this into a RRIF and we're going to have to take a minimum amount of money out. We're going to have to pay tax on that money, all these types of things. So people are curious, how does that work? How does that fit into my retirement? So today what I did was I gathered some of the most common questions that I get about RRIFs. So first question is just, what is a RRIF and how does it differ from an RRSP? So a RRIF is a registered retirement income fund as opposed to the RRSP, which is a registered retirement savings plan. So in the name kind of gives it away a little bit. Is the savings plan, the RSP is what you're saving into, you're saving for retirement. And the RRIF, the income fund, is where you take income from in retirement to create an income stream. So unlike an RRSP, when you have a RRIF, you can't put money into it. You can only take money out of it. And one of the other differences is, so you do take income from a RRIF. So you can set up a systematic withdrawal plan where you have, say, a monthly income coming from that account back into your bank account. Where with an RSP, you can't do that. You can only set up a PAC, pre-authorized plan where you have money going into the account on a regular basis, but you can't have money come out on a regular basis. That's from the RRSP. So the RRIF also has some other nuances, I guess. So the main one is that once you have a RRIF, you do need to take an income. There's a minimum you have to take out every year. So you can't just convert to a RRIF and then never take any money out of it. So that's one of the other differences. So we'll dive into some of the other stuff through these questions. So probably the most common question I get is, when do I need to convert my RSP into a RRIF? So by the end of the year that you turn 71, you have to at least take your RSP and move that money into a RRIF. In that year, you don't actually have to take any money out. There's no minimum the year you convert to a RRIF, but at age 72 in that year, you do then have to take the RRIF minimum. So you don't have to do it at age 71. You don't have to make that conversion at that point. You could do it earlier than that, but you can't do it after age 71. So how are the RRIF minimum withdrawals calculated and do they change over time? So they are based on a percentage of the RRIF's value at the start of each year, and they increase as you age. So the percentage is based on your age is how they come up with it. And so just to give you an example, at age 65, the minimum that would have to come out of a RRIF if you have moved money into a RRIF is 4% of the starting year balance or account value. So 4% would have to come out that year. By the time you get to age 75, it's basically 6% or just over 6%. By the time you get to age 85, now it's up to almost 10%. By 86, it's over 10%. So it is gradually going up. And the idea here is that the government wants you to have taken and emptied those accounts over your lifetime. Okay. So there are minimums you have to take, but again, you don't have to take anything out of your retirement accounts until you turn 72. That's when you have to do it, as I already mentioned. But anytime you've got them over there, that doesn't matter what age it is, that minimum withdrawal is going to start increasing over time. So what happens if you don't withdraw the minimum amount required? Well, there could be some penalties, but at the end of the day, it's on the financial institution that you have your money with. It's on them to make sure that those RRIF minimums are paid out. So it's probably not something you have to worry about. That will happen. And again, that's going to be on the financial institution that you're working with. Are RRIF withdrawals taxable and how is the tax calculated? So yeah, RRIF withdrawals. So when you take money out of your RRIF, just like when you take money out of your RRSP, that is fully taxable as regular income. So it goes right on your tax return as income. And depending on whatever your marginal tax rate is, that money is, so that income is going to be charged tax. So the amount you withdraw, so it's added to your total income. And so some things to consider here is like that could bump you up into a higher tax bracket. And there is also withholding tax taken off of your RIF withdrawals on anything above the minimum. So the minimum, when you take a withdrawal, if you're just taking the RIF minimum, you don't have to have withholding tax withheld. You can just get all that money into your bank account. Keeping in mind, it is still fully taxable. You're going to have to pay the tax on it. You just don't have to pay the tax on as you take it out. If you take out more than the minimum, which you can, then that amount is going to be subject to withholding tax just based on the amount you're taking out. But often for our clients, depending on their situation, we will have some withholding tax taken on the RIF minimum because they don't like paying taxes, and you probably don't. They don't like paying taxes at tax time or as a lump sum. I'd rather have it kind of taken off and paid before they actually see it in their account. But there's also the flip side of that, where a lot of people, and which does make sense if you know you're going to have the money to pay the taxes. A lot of people would rather keep that money in their own account so they can be getting the interest instead of CRA and then pay the tax at tax time. So it's really up to you on the RIF minimum. Can you hold the same investments in a RIF that you have in your RRSP? So yeah, you can. You can hold the same investments. You could hold, stocks, bonds, mutual funds, ETFs within a RIF, just like your RRSP. The RIF is just the tax-deferred account for managing those investments in retirement, as opposed to while you're still working. Now, I say that doesn't mean that just because you're retired, you don't have to switch to a RIF right away. Again, that's just age-based and based on your plan. But you can hold the same investments in there, and it continues to be tax deferred, the growth, the dividends, the interest, until you take withdrawals out of that RIF account. What happens to your RIF when you pass away? So depending on your situation, it could, if you are married or you have common law spouse, that RIF's value can transfer tax-free to your spouse or common law partner. And that's the same with an RRSP or a RIF. Now, without a spouse, it's taxed as income in your estate's final tax return, unless it's left to a financially dependent child or grandchild. So there's a few nuances where that might be able to roll over tax-free to somebody else, but for in most scenarios, it's going to be fully taxable as income the year you pass away, unless you have a spouse that it rolls over to. Can you name a beneficiary for your RIF, and how does that work? So yeah, you can put a beneficiary. So unlike your non-registered accounts, you can put a beneficiary on your RIF, just like on your RRSP. So that ensures the funds transfer directly to your beneficiary, and they bypass probate, which is a bonus in a lot of ways. You can have your spouse, as we already talked about, and it allows for that tax efficient or actually tax-free rollover to your spouse. If you could also leave it to charity, because when you don't have a spouse, it is, again, fully taxable as income. So sometimes people may have charities that are important to them, and to offset the taxes that are going to be owed from the RIF or the RSP, you could put a beneficiary on there as a charity. So that money would go directly to the charity, and then the estate would get an offsetting charitable tax receipt. Or you could name your kids or some other individual as a beneficiary, and that would still go directly to them. It would bypass probate, but just keep it in mind that the estate is still on the hook for the tax. So often when we have multiple kids, and we know that everything's getting left to the kids, we'll often have it go to the estate, just because it ensures that the money's there to pay the taxes. So that's not always the case, but that is kind of a standard practice that we start as our default, I guess you could say, because again, if all that money goes directly to the kids and there's not enough assets left in the estate, then the executor has to go back to try to get that money to pay the taxes. So just to keep things simple, we'll often have it go to the estate. How do RIF withdrawals impact government benefits like OAS? So taking money out of your RIF as a withdrawal is just like any other income. So it is added, as I mentioned, to the total income for the year. And then the higher your income is, the more your other benefits are going to be affected. So for example, the old age security clawback, if you go over the threshold, which is around $90,000 now, if you go over that because you took money out of your RIF or your RSP, then you're going to start to see that OAS clawback. So it's just like any other income. Are there strategies to minimize taxes on RIF withdrawals? So yeah, there's some strategies, including withdrawing funds before you're required to convert to a RIF. So you might convert to a RRIF, start taking income before you have to start taking the minimum at age 72. And that will help you with a lower balance when you get to the point where you have to take a RRIF minimum, which could potentially reduce the tax. You can split income with your spouse. So once you're age 65, you can convert that RSP to a RRIF, and that's now pension income. And pension income can be split with your spouse. So yeah, it does open up an opportunity to split income and have some tax savings there. Additionally, if you have not maximized contributions to your tax-free savings accounts, depending on your marginal tax rate, it could make sense to take money from those registered investments and get them into a tax-free savings account so that the growth from there, so you have to pay some tax because it's income when you pull it out, but from there, all that growth, dividends, interest is all going to be tax-free. And when you take it out of the tax-free savings account in the future, it's not going to go into your income. So it won't affect government benefits like old age security, for example. You won't pay any tax on it. It won't bump you into a higher marginal rate. And so that could make sense depending on your situation. There are other strategies as well, but with every strategy, there's always kind of two sides to it, right? So it might make sense to take some money out of your RRIF earlier than you need to. And the flip side is, though, often it makes more sense to keep the money in the RRIF as long as possible to get that tax-deferred growth. Now, whether that makes sense for you or not is going to depend on your situation, your marginal tax break or bracket. It's also going to depend a bit on what your goals are. If it's maximizing sustainable income, is it leaving a larger estate to the next generation? So this is where planning comes in, because you really need to try to figure out what's going to be most efficient for you and for your goals. But there's definitely strategies to how you handle the RRIFs. Can I convert my RRIF back to an RRSP? As long as you are under 71 or 71 and under, you can move money from a RRIF back into an RRSP, right? So if you go to an RRSP, you're not necessarily stuck there forever. You can move it back. And then again, by age 71, you have to have, by the end of the year, you turn 71, you have to have those RRSP funds back into the RRIF. And at that point, you can't switch it back. One of the other strategies I didn't mention also is, even if you don't want to take money out of your RRIF, but you are age 65 and you have no other pension income, it makes sense to open a RRIF, put enough money in there to at least take out the $2,000 a year, which will get you the maximum pension tax credit. So it gets you some kind of tax-free money out of the account in the short term until you're ready to start taking a more regular income. So how do you decide on the best investment strategy within your RRIF? Now, you could look at things from a tax standpoint, maybe looking at like tax location strategies, but it's arguable of how much value that really adds. But most importantly, what you're doing is you're looking at your overall portfolio, including your RRIF, and it should align with your retirement goals, your retirement income style, and your risk tolerance, right? So your RRIF isn't necessarily going to be invested different than your tax-free savings account. It could be, but not necessarily. But the main thing is that all of this is working together to create a retirement income portfolio that's going to allow you to reach and meet your retirement income goals within your comfort zone. And the last question we have here is, what are the risks of outliving my RRIF savings, and how can I address them? So I think that while it's a understandable question, I think it's the wrong question. So what I mean by that is RRIF savings in of itself is not a retirement plan. So the real question, I think, is, how do I ensure I don't outlive my income? Because at the end of the day, that's what we're really talking about here. So this is where understanding and having a proper retirement plan in place is essential. So it's going to answer the critical questions that you have about retirement, such as, how should I invest? Yeah, that's one. But also, where's my income going to come from in retirement? How do I minimize the tax that I pay in retirement? How do I protect my retirement from unforeseen threats? So these are the types of things that a retirement plan is going to answer. So just thinking about your RRIF as a retirement plan is probably not the best idea. You want to think of it as part of the overall picture, your whole financial house, and you want to make sure that all the furniture in the house is working together as efficiently as possible, again, to help you meet your retirement goals. So those are, I think, 14 questions. So the 14 most common questions that I get about RRIFs. So hopefully you've learned at least something today and going through those questions. Now, the first step in getting your retirement plan, we've talked about this a lot lately, is understanding your retirement income style. So again, it's not just I have a RIF, that's my plan. It's what's your retirement income style so that you can start to build out the pieces of your plan when you create income in retirement. So if you want to figure out your retirement income style, shoot us an email, info@retirementplanningsimplified.ca, and just let us know you want a Reza link. Or you can go to the website, retirementplanningsimplified.ca. You could click on blog, find the show notes for this episode or any other episode we've talked about the retirement income style assessment, and you'll find in there, get your Reza, and you'll be able to find out your retirement income style. So I hope you've enjoyed this episode. I hope you learned something today, and I hope you're off to a great start in the new year. Take care.